Bloomberg News.
Let's check in with a well-known investor in Asia who's famous for advising clients to get out of equities just 1 week before the October 1987 crash. He also correctly predicted the recent U.S. stock market bottom in March 2009. That, of course, is Marc Faber. He's the editor of the Gloom, Boom, and Doom report, and he's our guest now live from Singapore. Good evening to you, sir. We just talked about the price of gold hitting a record high there in London today, the fixing price. You point out in your recent newsletter the price of gold's actually really just half of what it was in the 80s when you adjust it for inflation, right?
Correct. Actually, it's very difficult to say whether the price of gold is expensive or cheap. I think it might be actually less expensive than when it was at 300 in 2000 because of all the money printing that has been going on and because of the increase in debt loads around the world and also international reserves. They've gone from $1 trillion in 1996 to now over $1 trillion. So one could actually say maybe gold is cheaper today than it was at that time.
Does that make it a good investment right now? Are you buying gold?
Well, I think as long as Mr. Bernanke is Fed chairman, gold will be a very good investment. Since he became Fed chairman, gold has gone up by more than 2 times. And I would also argue that we had essentially a trading range of around, say, 850 to 1,000 that dated back to 1980. And the breakout of gold above 1,000 is very meaningful as long as the $1,000 level holds. If gold should drop below 1,000, then I would be very concerned that there could be a counter trend move that would be very violent. But as long as gold holds above 1,000, I think it could be like a breakout move such as we had in the Dow Jones in 1983, when we moved really for the first time above 1,000 after having traded between 1966 and 1982 between, say, 700 and 1,000.
Sir, you're joining us from Singapore. We're looking at Asia broadly now, particularly because the President of the United States is there on the ground. You are finding opportunities in the emerging markets in Asia right now. What do you like? What are you buying?
Well, basically, everything is relative. I mean, the opportunities are not as good as they were last March, when the markets were extremely oversold and valuations were extremely depressed worldwide. Now I would say there are still some opportunities. Stocks are not terribly expensive when we compare them with zero interest rates, and that's very crucial. I think that the unemployment situation in the US and the government's administration is so bad, I have to stress, so bad, that Mr. Bernanke will keep interest rates at 0% for a very long time, and that more stimulus will be needed. And so equities are some protection against this monetary inflation.
Which markets are you buying in?
Well, I'm not buying very much because I already bought, but let's say I would probably add to some positions here in Singapore, in Malaysia, Indonesia, Hong Kong, and also Thailand.
Okay.
And I think also Vietnam is quite an attractive market at this point.
We heard over the weekend from China's top banking regulator who raised a red flag saying that the Federal Reserve in this country's decision to keep interest rates as low as they are is fueling dollar arbitrage speculation that could pose risk to the stability of the global financial and economic system. Do you believe that right now?
Yes, that's correct, but we have to give also credit to the Chinese and the Japanese for having artificially low interest rates and having kept them artificially low for a very long time. I don't forget, in Japan, short-term rates have been below 1% for years and years. So they also drove speculation around the world. All central banks are in the same boat. They print money and drive speculation and basically don't do much for the standards of living of the average person, for the median household. What they do is shift wealth from a country's high GDP into the hands of the financial sector.
Well, you point out, sir, that with depreciating currencies, you often see volatility in equities. What is your forecast here in terms of the equity markets in the U.S.? Would you put money to work here in the United States right now?
Well, I have to say what has happened in the world over the last 10 years is that whereas there hasn't been a lot of consumer price inflation, there has been a lot of asset inflation. And because of the expansion of the U.S. current account deficit from $150 billion in 1998 to currently around $700 billion, down from $800 billion, the world has been flooded with dollars, and that has led to asset inflation and price increases outside the United States. So when I'm here in Singapore tonight, a dinner here in Singapore that used to be maybe half the cost of New York 10 years ago is now at the same level or even higher. And I think this trend will kind of continue, and that has made US assets relatively inexpensive. Let's say if I'm a European, I can buy now homes in the United States and farmland at much lower prices than in Western Europe. And so I think that the asset market in the US, the S&P, one thing I'm convinced of, it bottomed out at 666 on March 6, 2009. That level I don't think will be revisited. If the S&P drops towards 900, the money printer, Mr. Ben Bernanke, will print. If it drops further towards 800, he'll flood the system with his helicopters like there is no tomorrow. So in nominal terms, I think that stocks will go up, because if money gives you 0% interest, money is a very bad investment, basically, except for short periods of time during market corrections.
All right. Well, thank you so much, Marc Faber, for joining us live this morning from Singapore, editor of the Gloom, Boom, and Doom Report.
Hear more Bloomberg News reports on the Bloomberg Terminal at AV Go, on Bloomberg Television, and on Bloomberg Radio. Copyright Bloomberg LP 2009.